Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with daily insight on the Nasdaq-100 index, or the NDX, which is made up of 100 of the largest domestic and international non-financial innovative companies listed on Nasdaq. The NDX has been the barometer for U.S. large cap growth and also one of the best performing indexes over the last decade and a half, not to mention one of the most liquid index ecosystems in the world. Joining us this Friday afternoon, we have Mark Marex, Director of Index Research and Development with Nasdaq Investment Intelligence, for an update on technical indicators to watch in the Nasdaq-100. And Mark, let's take a look at the relative strength index indicator, because a lot has changed since the last time that we reviewed these indicators.
Yeah, Jill, thanks for having me back. And yeah, kind of hard to believe how different things are now versus 2 weeks ago when we were talking about relative strength getting close to 70, which is the kind of green outlined part of this chart that usually denotes where things get overly bullish in terms of sentiment, anything above 70. So we had that really great rally going on for about 2 months there since mid-June. And then sort of right after that, around when the Fed started to have its summit in Jackson Hole, you can see that dashed line just basically took a nosedive from almost 70 to now below 40 and reaching sort of the other end of the extreme, which is the 30 line, which usually anything below there is extremely bearish. You could see earlier this year we've approached and even crossed over that 30 line a couple of times. So, you know, big changes in a very short period of time. Kind of remains to be seen if this is just a temporary correction to take the heat off of some of the, you know, really nice advances we've had this quarter. Or if it's going to be something that ends up testing some of the lows from earlier this year. Going to definitely keep an eye out on the sentiment here. I think if we keep going towards 30, we'll be due for a bit of a bounce back up, because there hasn't been too much news recently in terms of, you know, anything like earnings or anything like that. We'll see. Yeah,
typically happens when you're in that vacuum of earnings and you're really just contending with the macro headlines. What if we take a look at the short-term moving averages?
Yeah, so last time when we looked at it, I think, you know, we were crossing over the 20, and I was saying it's going to be pretty important for us to try to bounce off of that 50-day moving average line. That's the red there. And I've circled that we've kind of crossed down below it now most recently this week. We've lost that area of kind of shorter term support. And I've highlighted here, you know, a couple times recently when that's happened, it's been sort of tough to bounce back right after that. So that brings us to the next slide. That's the one where we start to look out to some of the longer term averages.
Yep, and let's take a look at that to see what's being indicated there.
Yeah, so here we've got the 100-day and the 200-day. Interestingly, actually, the 100 and the 50-day, they're pretty much at the exact same point. They're about to cross each other potentially. So here you've got the Nasdaq dropping just below its 100-day, just as it did with the 50-day. So unfortunately, not much support there, and you can see that we never really got above the 200-day. So it's probably, to me, this is a setup for a pretty choppy market over the next couple of weeks at least. There's not too much, you know, support from down below. There's not much resistance either, and there's not too many catalysts in terms of, like you said, we're in kind of an earnings. Not blackout, but an earnings kind of quiet period between now and early October when 3Q numbers start to get reported.
And finally, Mark, let's take a look at options positioning and vol Q.
Yeah, so options, kind of the inverse of that RSI line that we saw on the first slide. You see that last really kind of vertical tilt up where we were kind of below 0.6 in terms of the put to call ratio for the US equity market as a whole. Now we've blown past 0.7, which is usually the kind of borderline in between bearish and bullish. So anything above 0.7 puts to calls. That's a pretty bearish environment in terms of options positioning, and we're approaching 0.8 now. In terms of vol Q for NDX, you know, there has been a bit of a spike. We're now up around 30. We were in the 20s for a couple months there. 30, though, on a relative basis, still pretty low compared to some of the stuff that we saw even just in 2020, well after the initial COVID scare. we saw 40 approached and touched a couple times. And earlier this year, we also saw 40 approached a couple times. So not really a volatile market that we've gotten into. There's not a ton of fear and panic. I think it's more just people reacting to the Fed, maybe reacting to kind of a reiteration of a hawkish posture that people thought would maybe start to get let up a bit, as we've seen things like gas come down, other drivers of inflation come down this summer. Again, I think the most important thing for the rest of the year is inflation going to stabilize? Is it going to start to normalize downward? Can we keep those gas prices low? If that happens, I think the earnings picture is going to hold up pretty well for most of the index. That's what we've been seeing most of this year, and don't see many catalysts for that to be changing in the short term. So fingers crossed for a good rest of the year as we get out of the summer and into fall.
All right, sounds good, Mark. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.